Welcome to the Equity Expert Podcast. I'm Jen Namazi, and I'm the Director of Content for the NASPP. Today, I'm joined by our Executive Director, Barbara Baksa, in what is the third of a series of episodes we are doing that cover some of the data, the trends and observations emerging from the NASPP and Deloitte Consulting 2020 Domestic Stock Plan Administration Survey. So before we get started, as I usually do, if you're familiar with the podcast, I want to remind our audience that this episode is part of a series, our Equity Expert podcast series, and it features discussions with a variety of professionals on some of the practices, trends, and career-related topics in the area of stock compensation. You can find our podcast in a number of places. It's direct on our website, naspp.com, and also on the podcast apps like iTunes, Stitcher, and Spotify. So moving on to the topic of the day, we are going to be discussing survey data. And I want to take just a moment to give a little bit of context for the data that we'll be discussing. So the 2020 Domestic Stock Plan Administration Survey was developed jointly by the National Association of Stock Plan Professionals, NASPP, and Deloitte Consulting, and it provides a detailed look into the administrative practices of companies that are primarily headquartered in the United States. So some of the topics covered in this particular survey are around stock administration and communication practices, things like staffing, where stock administration is placed in the organization, telework, employee stock purchase plans, insider trading, and stock ownership guidelines. So today we're going to be talking about just one aspect of the survey, and that is related to insiders, and that will include things like 10b5-1 plans. You can find discussion on the other survey topics in some of the other episodes in this series. We've already produced a couple of other ones, and we have another one planned, so they cover all the other topics of the survey that I just mentioned. So be sure to check those out if you're interested in more information about the rest of the survey. So with that, we'll get started, and Barb, thank you again for joining us today.
Oh, glad to be here. Thanks for having me.
So since we're talking about insider trading compliance, I know we have some interesting data on things we found within the survey or observed from the survey, but I thought it'd be good just, this is an area where I think over years companies have really developed a lot of strong compliance attitudes and practices. So I think we've kind of continued to see growth in that area over a number of surveys and years that we've been doing this survey. But as a lead-in, I thought it'd be good just kind of put a lay of the land there as to, how are companies approaching insider trading compliance?
I would say that most companies, at this point, I don't know how you could be a public company and not have an insider trading compliance program. So, what we see in the survey is that 99% of respondents have an insider trading program, and most companies manage insider trading through a number of different mechanisms. A lot of companies use blackout periods, and we're going to talk more on that as we get through, as we go through the podcast. But blackout periods are very, very common among public companies. Also, we see that a significant percentage of public companies have pre-clearance policies in place, usually just for their top insiders. We don't usually see those policies extend down below the insider population, but it is very common for insiders to have to pre-clear all of their transactions with someone at the company, oftentimes someone in the legal department, and then also education is an important component of insider trading compliance, making sure that employees understand what the rules are and what the penalties could be if they violate those rules.
So just, before we dissect some of the specific segments of these plans and policies and practices, I want to just touch on captive brokers for a moment. So I know in the world of stock plans, it's very, very common and really the prevailing practice for a company to use a designated broker or brokers to facilitate transactions, especially in the marketplace relative to their stock plan. And I want to see how that translates to insiders. So, they're typically people who require a little more care and maybe even have some strong preferences in this area. So, what did we find out about the use of a captive broker?
Well, right now, the majority of respondents allow their insiders to use their company's captive or designated broker, but they don't require it. 88% of respondents indicate that they do not require insiders to use the company's captive designated broker, except in the case of cashless exercises. So if insiders are conducting same-day sale exercises, in that case, 64% do require their insiders to use their company's captive or designated broker. That just makes a lot of sense. It allows them to that broker is really set up to handle those transactions for the company, and letting insiders use just any broker they want for those transactions is likely to be fraught with any number of problems. So it's not surprising to see that a majority of companies want insiders to use their captive designated broker for their same-day sales, but for other types of transactions, or even just where the insiders hold their stock, they're not usually required to use the company's captive designated broker. I think there are a lot of advantages to having the insiders use the company's captive designated broker. It gives the company a little bit more control over the insiders' transactions. It gives it gives them a little bit more insight into what the insiders are doing. It sort of facilitates getting reports back from the broker on insider transactions, which facilitates the Section 16 reporting process. So I think there are a lot of advantages, but I think most executives sort of oftentimes balk at the idea of being forced to use the company's captive or designated broker. They likely have their own relationships with a financial advisor and with a brokerage firm, and they oftentimes don't want to move their accounts over to the captive designated broker. And these are folks who have a lot of authority and a lot of power in the company, and so I think in a lot of cases, companies just aren't willing to impose that restriction on them, except in the case of same-day sale exercises where it's just not, these days, it's oftentimes just not feasible to facilitate that exercise outside of the company's captive or designated broker arrangement.
Well, and I definitely agree. I think that as a as a best practice or a strong practice, there is a level of yes, a captive broker would be the ideal, but certainly understanding that there are those nuances where some executives just really have strong, preferences. Otherwise, I think whatever path the company takes there, I think that there's a strong message around you need to make sure you have a really strong relationship and process. So if they're not using the captive broker, you definitely want to make efforts to, ensure that you have communication and strong processes with whatever broker they choose to, mitigate or minimize potential compliance issues, like things like Section 16 reporting on time and things like that.
Yes, absolutely. No matter what broker they're using, the company should be getting reports from that broker of their stock plan transactions so that they can prepare the Section 16 forms for the insider, and should have a good relationship with that broker, and should be able to get information, and in some cases, if they need to impose some sort of blackout period or something, be able to do that through whatever broker the insiders are using. So yes, I agree. They still, whatever broker they're using, the company should have at least some level of relationship with that broker, and there should be some communication back and forth. And the insiders should be, they should have to sign whatever kind of release is necessary to facilitate that relationship between the company and that broker.
So with that in mind, I want to touch on 10b5 Rule 10b5 1 plans, and these are I'm a strong advocate for them. I feel like when they're done correctly, this type of trading plan can help, again, mitigate against a lot of either allegations of trading on insider material, non-public information, or just kind of put some distance, appropriately between an insider and their trades. So with that, these plans have sort of, they haven't been around for decades, but they have been around a number of years now. And so I want to just kind of explore what's happening on the 10b5-1 plan side of things and what are we seeing in terms of some trends there.
Yeah, we are, I think, definitely seeing growth in the use of 10b5-1 plans. And I should say, just going back to your first question about how companies manage insider trading compliance, I think that the use of Rule 10b5-1 plans, especially for company insiders, so executives, Section 16 insiders, and other people who have access to material non-public information, is a growing strategy that companies use to manage insider trading compliance for those folks. Right now, we see in our survey, 40% of respondents permit all employees. So anybody at the company could participate in a Rule 10b5-1 plan. Currently, only 9% require insiders to trade under 10b5-1 plans. So I would say for most companies, it's an option for insiders. They can implement a 10b5-1 plan if they want, but most companies aren't quite yet taking the step of requiring trades to be under a 10b5-1 plan. But trading under a 10b5-1 plan does offer a lot of protection to both the individual and to the company. And I have to wonder if, especially with what we've seen over the past year with the volatility in the marketplace and the really significant potential for people to have material non-public information as companies try to adapt to what's happened in the economy and what's happened in their own businesses. I think that trading right now has become probably more problematic for a lot of in a lot of companies. I think about what just happened with Pfizer, where they announced that they have this vaccine that's potentially very successful, and then shortly after that announcement, I see other articles in the news about their CEO selling stock. And I'll admit I haven't really paid a whole lot of attention to that, but I think it's just one example of how with with everything that's gone on in market volatility and companies having to make announcements and things this year, that allowing just trades just at the direction of the insider without sort of a formal plan in place can end up being problematic. And I have to wonder if after this year we're going to see more companies looking at maybe we should be requiring insiders to trade under Rule 10b5-1 plans so that their trades are more structured and there's less opportunity for them to trade in response to developments or announcements that the company's making. And even if that's not why they're trading, it helps in terms of the optics. If the company can just say, hey, yes, this trade happened, but it was a plan that was set in place 6 months ago or a year ago, I think that's a much better story to tell than we made this announcement and our CEO decided to sell a bunch of stock.
Well, yes, and with the Pfizer, it's funny. I saw the same news you did, and I do think there was a 10b5-1 plan. I think a lot of the questions around it came from there's uncertainty as to when that 10b5-1 plan was adopted, and so the footnote of the Form 4, I think, mentioned. It being the day before another significant event back in August related to the vaccine. There was other comments out there that maybe it was adopted earlier and amended, but there was a lot of uncertainty around that, which again, back to like when a 10b5-1 plan is done correctly and at a distance and there's a lot of clarity around that, I think it could be a really fantastic vehicle to really distance, right? Because the first thing I saw was all these articles saying CEO dumps the stock, sells the stock. And it's like, well,
Yes.
they did, but there was a 10b5-1 plan. Now, there are some questions around kind of how that plan was put together, which could kind of be favorable or not, depending on what the answers to those questions are. But the optics, right? The optics were immediately there. And so kind of coming back around to if there was a plan that was put in place and not, modified at odd times, then, that could be a really great way to kind of dispel some of this, hey, there's a plan and it was in place for a long time. So again, those answers aren't quite clear just based on what was on the Form 4 and some of the other conversation. But I agree, like, the last thing you want is to have this really public scrutiny and not be able to have a strong reason to explain, the timing of it, which a 10b5-1 can definitely help put some perspective on that.
Yes, I agree. And it also does show that a 10b5-1 plan isn't necessarily a cure-all. It is a great tool in terms of protecting insiders and protecting the company from SEC scrutiny or even enforcement actions or prosecution by the SEC for insider trading. But the press is going to interpret those trades however they want. And it is true that they sometimes don't, the sort of the nuances of a trade under a 10b5-1 plan versus a trade that was just a decision that the insider made at the time the trade occurred. I do know that the press doesn't always understand quite that, the nuance there between the timing of when the decision to trade is made. So it's certainly not a cure-all, and doesn't mean that you're not going to end up with negative press about insider trades, but it does certainly protect against scrutiny from the SEC.
Yes. Yep. All right. So let's shift gears a little bit and talk about something peripheral, which is blackout periods. And there's this concept, and a lot of companies have adopted blackout periods, particularly in cases where it's just known that there's going to be some material non-public information out there, and just employees probably shouldn't be trading whether or not they have the information, right? In some cases, but most definitely to protect the company and its employees just from the possibility of acting on information when they shouldn't probably be trading. So with that, I know we've seen some trends based on both employee rank and also company size. So I want to just touch a little bit on what we're seeing there.
Sure. And blackout periods are a topic that I get asked about with some frequency. And usually what people are asking is who at the company should be subject to the blackout period. And across the board, high-ranking employees are going to be subject to the blackout period. So it doesn't matter what size the company is or what industry you're in. If you're a public company, chances are, I would say virtually 100% of public companies use blackout periods in their insider trading program. And the percentage of those companies that make sort of high-level executives, so they're Section 16, they're named executive officers, they're Section 16 insiders, and people at the company who have access to material non-public information. It's upwards of well over 90%, over in some cases 95%, make those people or subject to their blackout periods. So that's not a particularly interesting thing to talk about because pretty much what everyone does. But where we do see variation in practice is when we get to middle management employees and below. It is much less common for employees in middle management and lower ranking employees to be subject to blackout periods. Overall, only 61% of respondents make middle management subject to their quarterly blackout periods, and only 47% subject exempt employees to quarterly blackouts, and then only 35% subject non-exempt employees to quarterly blackout periods. So it's less common for those folks. We also, though, see a very, I think, marked trend by company size. So smaller companies are much more likely to make those lower level employees subject to their blackout periods. If I look at companies in the survey who have less than 1,500 employees, so that's a fairly small public company. For those companies, 81% make middle management subject to blackout periods, 66% subject other exempt employees to their blackout periods, and then 44% apply their blackout periods to non-exempt employees. And I think that the reason for that is that if you are a small company, say only 1,500 employees, everybody has a lot more access to information. You're probably sharing information more widely. Everyone, employees know a greater portion of the company. They're interacting with a larger percentage of the company in their daily jobs. And so they probably just in general at a smaller company, a greater percentage of the company has access to material non-public information. And because of that, I think the companies that are smaller feel like it's more important to have these lower ranking employees subject to blackout periods. If you are a very large company, say worldwide, over 100,000 employees, these lower ranking employees often have just a very sort of limited view of the company, and really just a view of sort of their division or their area of the company, and so it's not as, you're not as worried about them having material non-public information that would be sufficient enough to influence investment decisions or change the price of the company stock, and as a result at those larger companies, these lower level employees are a lot less likely to be subject to blackout periods.
So let's, staying on blackout periods for a moment, let's talk a little bit more about, there's some things that we know are prohibited, right? Like prohibited within the blackout period, but then there are things that could potentially be exempt from restriction during the blackout period as well. So it may not be the blackout period applies to absolutely everything. So let's just break that down, what's permitted and what's not during blackout periods.
Well, not surprisingly, any transaction that involves an open market sale is likely to be prohibited during a blackout period because really those are the transactions that the blackout period is designed to create protection against is open market transactions. Those are the ones that are most likely to be scrutinized by the SEC. If there's any sort of investigation, those are the ones that are most visible to people outside the company, that are likely to be noted in the press. So not surprisingly, same-day sale exercises, sell to cover, anything that involves an open market transaction is very likely to be prohibited during a blackout period. For other types of transactions, however, practices vary pretty considerably. If we look at sort of net stock option exercises, around 58%, just under 60% of companies prohibit those during their blackout periods. 51% of companies prohibit cash exercises, so that's 49% that are going to allow a cash exercise during a blackout period. Something that I get asked about quite frequently is share withholding on restricted stock or unit awards. Should that be prohibited during a blackout period? And we can see that only 32% of respondents prohibit that transaction during a blackout period. So that's almost 2/3. It's over 2/3 of respondents that allow share withholding during a blackout period. Gifts, 45% of respondents prohibit gifts. So that's 55% that are going to allow a gift during a blackout period. And then only 21% of respondents prohibit changes in ESPP contribution rates during blackout periods.
This is one thing that's just popping up for me is, when you talk about share withholding during a blackout period, I feel like this is an area where, company can adopt a policy around this, but on the flip side, they also have to make sure that, their grant practices are setting them up to really be congruent here. So, I've seen companies where, they've got a grant cycle that they end up granting like restricted stock units or awards during what would a year later be a blackout period, and then that vesting event occurs, and then there's not maybe not the typical method available, which could be share withholding to be able to satisfy the taxes. So on the planning side of things, as companies make this type of policy, if they do end up prohibiting a net withholding, even though it's not the majority, but it's still a significant number of companies that are doing that, I would strongly encourage some collaboration on the HR grant process side as well to make sure that that restriction can stand based on when vesting events are scheduled to occur.
Yeah, and I mean, here again, you can, for restricted stock and unit awards where the timing of these events is predictable, you can build a 10b5-1 plan into the grant agreement or execute one separately that would allow these transactions to occur during a blackout period if your vesting events are such or your payout events are timed so that they occur during blackout periods. There are other solutions if your company does feel like these transactions need to be prohibited during blackout periods. For option exercises, you wouldn't be able to build a 10b5-1 plan into the grant agreement because you don't know the timing of when those exercises are going to occur. But certainly, once you get down the road in the life of the option, and the employee is at a point where they're exercising the option, there again, they could implement a Rule 10b5-1 plan that would allow them to do these transactions during your blackout period, even if they would otherwise be prohibited.
Great example there. All right. One more thing I want to hit on relative to blackout periods is just the length of them. So, and I've seen it, I remember when I used to work in companies, it could be all over the place, right? It could be just a matter of days, it could be a month, it could be longer. So let's just touch on the length of time that companies are having these blackout periods in effect.
Yeah, so most blackout periods are scheduled around the end of the company's fiscal quarter and their earnings release. So that's sort of how we approach the length of the blackout period question. So first we ask, when do you start your blackout period? And we ask for that timing in relation to the end of your fiscal quarter. And so around 80% of respondents start their blackout period at least 11 days, possibly more, before the end of their fiscal quarter. So it's a pretty, it's a pretty wide time period. If we can narrow that down a little bit, 32% are starting in the 11 to 15 day time period, so it's about a third. And then another 28%, so just under a third, are starting their blackout period more than 25 days before the end of their quarter. So you can see there's about a third who are starting sort of just 2 weeks before the end of the quarter, and then another third that are more than a month out from the end of the quarter almost. In terms of when the trading period opens, most companies are opening it really shortly after earnings are announced. So 48%, so almost half, are opening their trading window either 2 business days or 2 calendar days after earnings are announced. And then another 30% open their window just 1 day, 1 business day or 1 trading day after earnings are announced. So you can see that's about almost that's 80% of companies almost, that by the time we get to 2 days after earnings are announced, people are able to trade.
And that makes a lot of sense. I could completely understand because once the information is out there, really, there's
Right.
not a lot of need to further impede or restrict the employee from trading because they're now with the public in terms of having that information. So definitely makes sense. Short time frame on the after release of information.
Yeah, and I think you're absolutely right. Once the earnings are announced, the information's public, so people don't. It's not material, non-public information anymore. You can let people trade. In terms of the timing of when you go into the blackout, I think that probably depends partly on your business cycle. So how near the end of the quarter do people start to have an idea of what the quarter is going to look like? Are you in a business that's very volatile and people aren't going to really have an idea of what your quarterly numbers are going to look like until just before the quarter ends? Then you probably don't need to go into the blackout period quite as soon. But if you are in a business where it's a month out and people are starting to get an idea of what the quarterly results are going to look like, then at that point you probably do need to go into a blackout period. And also probably also to some extent the size of the company may matter here as well.
All right. So last question want to touch on today, or last area I want to touch on today is, I know I've heard this question a fair number of times, and that is, who's responsible for handling the reporting of insider transactions. So when we talk about reporting, we're really talking about SEC reporting forms, 3, 4, and 5 or 144 forms. So let's just talk about, who typically has that responsibility within the organization.
Sure. So for forms 3, 4, and 5, it is most often going to be in-house counsel. 60% of respondents say that in-house counsel is responsible for Section 16 reporting. I know I talked to a lot of stock plan administrators who are responsible for it, but those companies are actually in the minority. Only 31% of respondents make stock plan administration responsible for Section 16 reporting. It's just a little higher than the percentage that make the corporate secretary responsible. 26% of respondents house Section 16 reporting with the corporate secretary. And those are really the top 3 responses in terms of who's going to have to prepare forms 3, 4, and 5. For form 144, I'm always surprised. Back when I worked for a brokerage firm, so we're going back now 15, 16 years, I always thought it was the broker that did this. But according to our survey, only 46% of respondents say that their broker is responsible for filing Form 144. It's still the top choice, but it's not even half. 37% say in-house counsel files Form 144, 17% make the stock plan administrator file Form 144, and then another 17% make the corporate secretary file it. And those are the top 4. Everything else is below 10% of respondents.
Well, some definite variances across the board, but nothing truly surprising. I think some responsibilities tend to be split in organizations for different ways. It certainly makes sense to me to have in-house legal really put eyes on, these filings before they occur, just because they come from that legal perspective. And, certainly would be instrumental in making sure that they are correct, at least as a separate set of eyes, if not as the primary responsibility. So
Yeah, we're only asking who's actually primarily responsible for completing and filing the form. We don't ask about who else has to review the form before it gets filed. And I have to believe that in any of these companies where it's the stock plan administrator who's preparing the filing, I have to believe that in-house counsel is at least reviewing it before it gets filed with the SEC. Unless the stock plan administrator has a legal background, or I find it hard to believe that companies wouldn't have legal at least look at the filing before it gets submitted. And I would just say that if you are a stock plan administrator and you're responsible for Form 144 or for Section 16 filing, and you're thinking, hey, I don't want to do this, I really think my legal department should be doing this, our survey supports you. That's what we see.
well said there, and I would tend to agree. And that really wraps up, I think, the information we wanted to put out there about some of the highlights around insider trading compliance. And so, Barb, I want to thank you for joining us today. As always, it's a pleasure having you.
Oh, yeah, absolutely. Happy to do it. And thanks for inviting me to do it and giving me another opportunity to talk about the survey.
And on that note, for those who are looking for more information about the survey, we do have a number of resources available. Some are available to NASPP members only, others are publicly available. So there will be a list of those resources in the show notes on our website for this episode, and also within the podcast apps as well. So feel free to click on any of those resources that you would find more insightful. And we get a lot of questions on the full results of our survey. So where are they available and who can access them? So the results are available now to qualifying NASPP members. For more information on who gets access and how, please visit our website. You can go to naspp.com, navigate to our research center, and click on surveys. As a reminder, I just want to remind everyone that we are covering the other highlights from the survey in our next episode. The last segment of this series will be on stock ownership guidelines. So if you are interested in being notified about that when that episode is up, be sure to subscribe. You can do that through your podcast app or via the podcast page on our website, naspp.com/podcasts. And we will notify you when that episode is available. Thank you all for joining us, and we will see you on the next episode.